in terms of like what might be coming next and what businesses might be looking for, over the next 6 to 18 months when it comes to blockchain beyond finance and beyond supply chain. So a little bit of an outline there. So starting with our blockchain 101, I want to first start by essentially motivating Bitcoin in terms of looking at the genesis of this technology, because if we understand the genesis of Bitcoin, i.e. the first blockchain, I think that can really help us in understanding what its value propositions are and how organizations, individuals, and even some fairly large enterprises are looking at understanding the technology and looking at its value propositions. So Bitcoin was essentially kind of motivated by the central question of how can we move value peer-to-peer, person-to-person, without any trusted intermediary. So if we think of Bitcoin, again, Bitcoin being the first blockchain, if we think of that as kind of like an alternative to PayPal, if I have a PayPal account and you have a PayPal account, we rely on PayPal to sit in the middle of that transaction and make sure I have enough money to fund it and make sure I only send that money once to kind of prevent fraud and basically clear everything through one person to another. The central goal of blockchain was to say, can we do that without a trusted intermediary? So again, you hear about blockchains a lot cutting out the middleman, and this really goes all the way back to the creation of Bitcoin. A few maybe interesting pieces about the early history of Bitcoin. Bitcoin was created anonymously. The only thing that we know about the creator of the project was a pseudonym, Satoshi Nakamoto, and oddly enough, he even kind of completely disappeared. He just stopped answering messages, stopped responding to anything, or even using Bitcoin only 3 years after it was launched. So to this day, and we are now coming on about 12 years, project's about 12 years old, 12, 13 years old, and we still don't know who actually created it. So depending on your leaning, it's either a fun area of mystery or, maybe delegitimizing. I definitely lean towards the camp of this is, a cool piece of open source history whereby, it truly does show how community development can be absolutely critical to building truly amazing technologies. So obviously it was created anonymously, but also maybe more importantly, this was not the first attempt to solve this problem. There were numerous other attempts actually coming out of what's called the cypherpunk movement in the kind of mid-90s to early aughts. And this created things that probably no one's heard of anymore, but they were maybe a little more well-known 20 years ago, including like DigiCash, Hashcash, and B-Money. So the important thing, Bitcoin was not the first attempt at this. It was the first successful attempt though. And then finally, it was very much motivated by the financial crisis. And this idea of being motivated by an erosion of trust, we'll see kind of over and over again throughout blockchain use cases that blockchain always comes in, or is at the very least considered, when there has been some sort of breakdown in institutional trust. When I say Bitcoin was motivated by the financial crisis, in addition to number of kind of references and a lot of conversation by Satoshi about financial trust and things like that, the first ever block of transactions, the first ever it's called a Genesis block in Bitcoin, the thing that kicked the whole network off, actually included this thing I have quoted at the bottom, the Times 3 January 09, Chancellor on brink of second bailout for banks. So this is what the Times of London was running on that day as their kind of main headline. So this reference to the financial crisis in the very first block of Bitcoin really solidifies the link between, again, financial trust and the first ever blockchain attempt, i.e. Bitcoin. Moving from our history a little bit to just what at a super, super high level is, we're not going to get technical at all, but what at a super high level blockchain actually is. So there's two things to keep in mind. First, where blockchain gets its name from, blockchains are organized into blocks. So I have a bunch of transactions. Alice is sending to Bob. Charlie is sending to Doug. And we're all kind of doing these transactions. And a blockchain will put them all into a block. And then we'll all agree on that block together. And then we'll start sending around a new set of transactions. We'll put those in a block. And we'll basically build going forward from there. So that's where the term blockchain actually comes from. It is a chain of blocks, quite literally. The second piece from an anatomy perspective that we want to remember is blockchains are distributed. Blockchains have many different computers, many different people involved that are all able to write to the network, secure the network, store all the data, and ultimately read that data. So we can actually kind of look at kind of these three examples that I have on the right side here in terms of a centralized system where everyone has to go through the middle, and then you can come out the other side, all the way to something that is, truly like a blockchain on the far right, where everyone can talk to whoever they want directly. So again, chains or a chain of blocks, and then distributed nodes. Those are really the two things that we just need to keep in mind when we think of what a blockchain actually is. Moving from what a blockchain actually is, we'll get into some of its value propositions in a moment. But before we do that, I want to maybe clear up, or at least limit a little bit, probably the most common misconception about blockchains right now. It's in the news all the time. We hear a lot about blockchains are incredibly energy intensive. We hear that Bitcoin now takes up more electricity than Argentina, than the Netherlands, and we hear things like that. And those are true for some of the older blockchains like Bitcoin or Ethereum, but very importantly, that isn't necessarily true for all blockchains. It's ultimately a matter of, and again, not trying to get technical or anything, but it's a matter of how we come to agreement, how we come to an agreement as to what valid transactions are and what valid transactions aren't. So generally speaking, there are two ways that you can do that sort of agreement process. First one being called proof of work. This was the original idea. This is what uses all those computers that are mining, solving kind of very difficult math problems. That was the original way that we were doing it. But then a few years later, we stumbled upon the idea of proof of stake, where instead of needing mining power to come to agreement, we could basically just say, oh, we're going to divide up ownership in the network, much like we would divide up the ownership of a company through stock or something like that, and say, based on your relative ownership percentage of the network, that's how many votes you get when we're all trying to come to agreement. And so while proof of work uses a lot of electricity because you are proving that you are working, that you are mining to secure the network, proof of stake has basically no more energy consumption than this Zoom webinar right now. And I can run Zoom on my computer actually at the same time that I can run a proof of stake blockchain. So it's really all about how we come to agreement, or you might hear the word consensus algorithm or consensus process describing how much energy that a blockchain uses. So I just want to clear up that misconception before we move into what's going to underpin a lot of the talk when we talk about, or when we discuss different use cases and different areas that blockchains are being adopted. We want to look at the value propositions, essentially, or what are the benefits of implementing blockchain. First and foremost, and this is probably one of the ones we hear a lot about, is the idea of immutability, or the idea of data being secured and tamper-proof. So really what this means is that once information is added to the blockchain, or added to the blockchain ledger, that data can't be touched anymore. I can add new data. I can say that old data was invalid, but that record that we put onto the blockchain will always be there, and no one can censor it, no one can corrupt it, no one can manipulate it or force it out of the network. So that data is fully secured and immutable. The second and kind of related value proposition to immutability and security is data verifiability. So this is the idea that whenever I might put information onto a blockchain, that information comes with a digital signature, meaning if I want to make a claim, maybe I want to say my company has no carbon footprint. We are entirely carbon neutral. In addition to the data that I would put on the blockchain, I would also be putting my signature. So this idea of verifiability really refers to the fact that any piece of data, again, comes with the signature of the person who put it there, and those signatures cannot be forged. So we can think of this in terms of either verifiability, i.e. I know who to go to have that data verified, but we can also think of it in terms of data accountability, especially accountability over the long term. because if my signature is there, because of the first value prop we just talked about, that signature is also immutable and it can't be tampered with, and it's part of the blockchain for all time. So data verifiability or data accountability is, one of the second value proposition that really needs to be introduced. Third, as we already discussed, blockchains are distributed or decentralized. Those two words are often kind of used interchangeably. And because they are decentralized in nature, they can run across, multiple machines, multiple companies. So they don't have any single point of failure. They don't have any single point where, if one company decides to stop offering that blockchain as a service, the blockchain can keep going without them. Contrast that to, a lot of stock exchanges nowadays or payment providers that if just their data center goes down, or if they decide to start censoring information, or they decide to shut down a service, that service is just gone. When it comes to a blockchain, there's no one party that gets to make that decision. And as long as at least one person or one computer is still running the blockchain, that blockchain is still available and all the data is there and secured. The final value proposition I want to touch on is this idea of data unification and also data sovereignty. One of the key areas, and this comes up in a lot of our own conversations when we're talking with large enterprises, is how does something like blockchain fit into a broader technology stack? Because I might have my ERP systems, I might have my own internal platforms or my own internal accounting systems or traceability platforms. How does blockchain fit in with all of that? The way that blockchain fits in with all of that is blockchain essentially fits in underneath as a independent infrastructure that multiple parties or multiple companies can all use to kind of write their data to it and get proof about their data. But the important piece of that is I can have one blockchain that's underpinning lots of different companies, one blockchain that's underpinning lots of different supply chains. So while my ERP system might be completely separate from your ERP system, if we're both using the same blockchain, it means our supply chains can now come into agreement, and I can move something on my blockchain accounts to your blockchain accounts without having to go through any other sorts of integrations or anything like that. And we can keep all our internal systems separate while starting to share data and share the ability to, I can verify you, you can verify me, and we can kind of start checking each other. So we can unify data at the blockchain level to save ourselves from having to figure out how to do integrations at like an ERP or an internal systems level. And then united to that idea of data unification is also this idea of data sovereignty. So one of the issue kind of with integrations and a lot of the hesitancy that we hear, maybe not hesitancy, but more confusion around data unification for blockchains is a lot of companies then think that means they are giving their data over to someone else. They think that, oh, maybe their competitor is involved in this platform as well, and maybe their competitor pitched the idea of a blockchain that the whole industry was going to use. They have the mistaken idea that that means their competitor is getting all their data. Blockchains are unique in the idea that they have data sovereignty, meaning that the data I put on the blockchain is my data. No one gets to control it. No one gets to take it away from me. No one gets to use that data. My data is controlled by me, even though we're all kind of sharing the same independent infrastructure underneath. So these are really the four value propositions that, again, will underpin a lot of the use cases that we're going to get to a bit later in this talk. So moving out of our first section to what I think is probably going to be a fun little lesson, again, in acronyms and abbreviations, is this alphabet soup of hype cycles and buzzwords that we hear about, and really then trying to distill down the value or the non-hyped value and the actual business value of the underlying ideas behind ICOs, DeFi, NFTs, and DAOs. And we'll unpack what all of those mean. So, as I was just saying, one of the things as you dive into blockchains is it can feel basically like you're drowning in a sea of buzzwords. And we're really going to try to work through that right now. So starting with definitions, first and foremost, an ICO or an initial coin offering is simply a means of distributing a new coin or token through a crowd sale. So, to a lot of people, And these people may be investors, users, or just other stakeholders or affiliated parties to of a new blockchain project. DeFi, also short for decentralized finance, is simply the term for any sort of effort or project looking to remake a financial instrument or a financial platform, but using blockchain technology. I do see that I have a question now. I just want to take a look at that to see if we're going to get to it or if we're going to address it. Now, how can we use blockchain technology to accelerate individual, multi-organizational, and even jurisdictional collaboration to solve humanity's tough problems? I think we will definitely be getting to that, but otherwise we'll be discussing that at the end, because I'm definitely going to touch on some of those themes as we're going. So thank you, Greg, for that question. We'll be sure to be getting to it. Moving from DeFi to NFTs, NFTs being non-fungible tokens, and these represent unique or limited assets. And again, we'll get to examples, but this is where you would think of like art or diamonds or luxury goods or collectibles. These are all just digital representations of somehow limited or unique items. They might be digital items, they might even be real world tangible items. And then finally, a DAO or decentralized autonomous organization is the blockchain world's attempt to rethink how we do governance in either communities or in organizations. So it's governance that is entirely done on a blockchain. Maybe that governance is anonymous with anonymous participants. Maybe those participants need to be named, but it's governance of, again, an entity or a community done entirely on the blockchain. So these are the four terms, and we'll be unpacking all of those and really looking to get to the value of them as well. I'm going to skip this. Sorry, what I wanted to touch on here is, as we introduce new acronyms like this, it has kind of an interesting correlation with just what the blockchain space seems to want to do from the perspective of price. So the first box we have over here, this is when the idea of ICOs were kind of introduced, and everyone was talking about token sales and things on the Ethereum platform and everything like that. Even DAOs to some extent were being talked about during that time. And then this most recent kind of crypto craze that's been consuming us for the last 9 months or so has really been driven by DeFi, originally kind of over the summer last year, but then more recently driven by NFTs. So as you would expect with maybe a space like this, the crypto prices and the crypto interest is definitely driven by the introduction and kind of the takeoff of some of those new buzzwords. Moving to basically look at the first two acronyms I introduced and how these actually provide value to businesses and can solve problems. We'll be looking at ICOs and DeFi and how that relates to using blockchain to raise capital, to do financing, and even do maybe less interesting things, but still very important things of payments and simply moving money from person to person or institution to institution. ICOs is where I want to start here. So ICOs, as we talked about a little bit, are a new way to raise money. Specifically, they are a new way to raise money for open source projects. So like, open source technology projects or anything that can be defined as a public good. Maybe it's something that doesn't make sense for a company to run, but there's a public interest in terms of, think of it like the digital version of green space or the digital version of a highway or the digital version of a bridge. Maybe it might be challenging to have a company that needs to do this, but nevertheless, there needs to be capital raised for it, and there needs to be some work done for that. So this is where ICOs come in, and really through ICOs, technology projects have unlocked a new way to raise capital that can be more transparent. It can be more problem and community driven, and it can really, and this is the most important part, at least in my view, it can encourage broader ecosystem engagement. And this is exactly what we saw with the Ethereum project, which by all marks of a technology effort has been a massive success. This one project has, more than 2,000 active developers. It has hundreds, if not thousands, of improvements that have been made to the core of the Ethereum technology that were entirely community submitted and oftentimes even community implemented, i.e. these extra things were done by people with no official affiliation to the project. There are dozens of different companies that are all working to make this technology better, and there have even been 4 new programming languages created out of this project. So if we want to compare this to something like Linux, which was kind of not one of the original, but definitely one of the more important open source efforts, this is, I think, in a lot of ways, a hypercharged version of it. Ethereum probably got as much done in about 4 or 5 years as Linux did in, I would say, the first 10 to 15 years of its history, simply because through an ICO, through greater community participation, Ethereum was really able to tap into a lot more resources and a lot more kind of interest and collective buy-in to move their project forward. Now, obviously, not all ICOs have been as successful. There have been a lot of silly or not so great projects. But one thing I do want to just bring up for a second is what I think a very, very interesting visualization of the amount of money that was raised through these token sales over time. So starting, as we see here, in 2014, and we have different colors here just highlighting where these projects were. So over time, we're going to see this number in the top left corner, especially through 2016 to 2017, really start exploding. So this is just kind of, like I said, I think an interesting visualization to show how quickly this idea, once it got going, really, really took off. Again, as we're about to dip into 2016 here on the timeline, we're going to start to see this little bubble cloud really start to go crazy. So I'm just going to let this run for a second. And one thing that we can also see, I guess here, I want to call attention to some of the colors and this idea that there was a lot of pink dots, meaning that we actually don't even know where these projects were based. They were literally stateless. Obviously, then a lot happened in Europe, some in North America, then maybe not as much as we would expect. And again, it really kind of went crazy in 2017, which was definitely an interesting time to be active in the blockchain space. But moving from ICOs and kind of this idea that I could raise capital for a new project, I want to move now on to what debt or what bond offerings have been doing with the blockchain space. So at the same time that we've been hearing about, Reddit traders and, people making day trades and trading Dogecoin at the same time they're trading AMC stock. So at the same time, all that's been happening. We're not going to worry about that. There have been some pretty major efforts to use blockchain technology to actually issue bonds, of all things, to issue bonds or to do asset-backed loans. So all the way back in 2018, the World Bank, in kind of consultation and partnership with some Australian banks, actually released a $100 million bond that was the first public bond on blockchain. 2 years later, Vanguard was working with a number of its partners to reduce settlement times for asset-backed loans. They started with car loans and then they expanded to other types of asset-backed loans. And they were actually using blockchain to reduce settlement times down from about 10 to 14 days all the way to 40 minutes. And then most recently, the European Investment Bank raised a 100 million euro bond using the Ethereum blockchain. And I think very much in a sign of the times, not only was this done using blockchain technology, but this 2-year note also had a negative interest rate on it. So I'm not sure what says 2020 or 2021 more than a bond with a negative interest rate being issued on a blockchain. But the reason I wanted to highlight this slide is because I think what's happening on the left in terms of DeFi or decentralized finance, or people doing all sorts of loans or leveraging themselves 100 times to trade more crypto, well, those are definitely the things that catch a lot more of the news. These much, much more substantial institutional happenings have really been going on in the background, in some ways in parallel, using similar technologies, but again, being used for very, very different use cases with, I would say, very substantially the side of things on the right piece of the slide is much more substantial and will be much more impactful down the line. Moving from bonds, I want to return at least briefly to really the original blockchain use case, which was payments, but look at how that's really been updated with a lot of these cross-border payment programs and the CBDCs, or central bank digital currencies, that maybe you're hearing about. This map here is essentially a map of all the different central banks, all the different countries in the world that are researching, piloting, or somewhere in development a central bank. So their central bank, the Fed, the ECB, whatever that country's central bank might be, they're actually playing around with launching their own blockchains or distributed ledgers to replace their bank-to-bank transfer systems. China has been doing a lot of this, especially, and has probably gotten further than most countries, in the sense that they are starting some early pilots where not only would this new system be used to move money between banks, but people would actually be able to participate directly in this new digital currency as well. A lot of the European countries and a lot of the North American countries, so the US and Canada, are experimenting with some more limited scope projects, in the sense that they're looking to replace, again, just their bank-to-bank transfer systems, but through the lens of trying to reduce transfer times. So instead of waiting for 3 days or 2 days for something to clear, you could do it in a matter of hours. You're looking to reduce the transfer fees, especially as you might be moving money internationally, but then also looking at a greater ability to drive coordination and just kind of drive cohesion through your ecosystem participants. Then, in addition to some of the countries themselves working on these projects, Visa and MasterCard have both been looking at integrating blockchain technology into their technology stacks to essentially overhaul a lot of their back office work, but also even make themselves compatible with Bitcoin payments or kind of other cryptocurrency payments, so that these cryptocurrencies could move along the same railways that they have as their traditional fiat payments. And then the last project that I want to highlight here is BIS, or the Bank of International Settlements, which is essentially the central bank to all the central banks in the world. And they, in kind of coordination with a few universities in the US and in Europe, are looking at actually creating a new interbank settlement system. So for banks in the US trying to send to another country, or vice versa, actually doing an international transfer system using potentially some form of blockchain technology. So it's kind of an interesting collision of things, that one of the most recent ideas that people are experimenting with on the blockchain side, these central bank digital currencies, actually goes all the way back to really the first use cases of blockchain for payments, which is what Bitcoin specifically was all about. Sorry, I'm trying to get to the next slide. Moving now from finance, and we've essentially covered our first two hype acronyms, but hopefully flesh those out a little bit and provided a bit more value context there of ICOs and DeFi, to now move on to NFTs, or again, this idea of non-fungible tokens, and how that relates potentially to the idea of blockchains for supply chains, whether that's tracking agricultural commodities, whether that's tracking energy, or really anything else. And we'll get to a few examples of that at the end of this section. First, what I want to highlight, though, is this idea of a token ontology. Token ontology really referring to how can we map the real world into a blockchain. So if you hear, like, maybe you attend an AI talk or something like that, there's always a lot of talk with new technologies as to how do we take the way things work in the real world? How do we take real models, real behaviors, real methods of interactions, and port them into this new technological landscape that we have? And this is exactly what we're doing when we're looking at how do we capture assets, how do we capture capital, how do we transfer or capture anything and represent that on a blockchain. And that's all done through a token ontology. And it's through that token ontology that not only do we get NFTs, or non-fungible tokens, but we also get other types of goods as well. And the way that token ontology works is really a series of decisions that we make. So if we start essentially here in the top left corner and we define what it is we want to be tracking, or what it is we want to be turning into a token on the blockchain. And the example I'm going to use, because it's an example where we'll return to, is let's take the example of diamonds. So diamond traceability is now, a really big issue, and the industry is looking quite hard at how to bring more traceability, how to bring more transparency to their supply chains, and blockchain is one of the things that they're considering. So if we start with basically the unit of 1 carat of diamond, or maybe even 1 diamond, we answer a series of questions to tell us what type of token that needs to be. And the first question that we ask ourselves is that token fungible? And what the word fungibility refers to is, can one thing be swapped out for another thing without anyone caring? So if I have a diamond and you have a diamond, generally speaking, we can't just swap those diamonds. Maybe my diamond is smaller, maybe your diamond has a better color to it, but those diamonds are not interchangeable. But the opposite of that being, if I have a quarter and you have a quarter, 25 cents, we could swap those back and forth and none of us would really care. So quarters or dollar bills are fungible, whereas diamonds aren't. So again, we answer no to the fungibility question, and we move from there, and we answer, we're looking to answer the next question of, is this thing unique? Something that would be unique would be like a piece of art. A piece of art is a class of one. It's kind of a class unto itself. So a piece of art or something like that would be unique. But there's a lot of diamonds that come out of a mine. So diamonds are not unique. They are non-fungible, but they're also not unique. The next question, and really the final question that we would ask here, is a diamond divisible? I.e., can I split 1 diamond into multiple little diamonds? The answer with diamonds is yes, I can cut a diamond and then I have 2 smaller diamonds. Moving from there, you would say, once I have cut my diamond, once I have divided it, can I actually squeeze it back together? Can I actually take what was broken and make it whole again? I don't know how many of you have ever tried to squeeze 2 diamonds together to make 1 bigger diamond, but I can tell you that does not work. So where we would be with diamonds is we would answer no on that final question, and we would end up with essentially this type of token. And at least our categorization, and a fair number of other people's categorizations as well, there's basically 6 token types that you can get depending on what it is that you are attempting to map into the blockchain world. And this exercise, while maybe trivial for some examples, is really the first step that any blockchain company and enterprise or organization will walk through when that organization says, yes, I want to track my energy consumption. I want to track my natural gas moving through pipelines. I want to track my coffee. I want to track whatever it may be. I want to track that on the blockchain. This is really the first exercise that a company and their blockchain provider will go to. Is they will go through the mapping of real assets into the blockchain. So that's why I wanted to do that with all of you now, essentially. But
we have one question in the QA section. Somebody's asking, wondering, how do we prevent or track criminals accessing Bitcoin through ransom? Is Bitcoin too good to be true?
Oh, yeah, absolutely. So, let's return back to finance for a second, because this is a very good point, and one that definitely needs to be addressed. If we look at the blockchain technology in general, blockchain technology has a major advantage over traditional systems, especially cash. So as we very briefly touched on early on in the talk, is a blockchain is a ledger. And that ledger, the set of all transactions that anyone would ever do on a blockchain, is public. So what that means is there is a record of every single transaction, legitimate, illegitimate, ransomware, or perfectly law-abiding. All of those records are on the blockchain. And what that means is, because you have this singular public record, you can do really, really incredible analytics, and you can really do incredible levels of forensic accounting on a blockchain that are, simply put, not available if you're dealing with banking systems or cash systems where these records are ad hoc and no one really has the ability to pull those records together efficiently enough or quickly enough to actually trace through and track down illicit use. So yes, Bitcoin does allow for some level of like, I can just create a new account and I can attempt to separate an account from my real world identity. But because every single transaction I make is part of that public ledger, the forensic accounting techniques are simply put too powerful to really use that to hide. And oddly enough, we saw, I think very early on in the history of Bitcoin, we saw a major shift, not necessarily from some of the politicians that are charged with regulating these things, but from their bureaucrats and from the people that are actually day-to-day trying to solve these problems. We saw a shift of, oh, we can't deal with blockchain, it's anonymous, things like that, to hold on, this actually is way better than cash because every single blockchain record has a transaction associated with it. Or, and has an identifier that we can look at, we can trace through, we can do our forensic accounting on. And this idea of being able to do accounting on, being able to bring traceability and transparency to financial transactions is actually exactly what a lot of other groups are doing with supply chain transactions, and kind of why I did want to address that right before I get to the supply chain side of things. So counterintuitively, Bitcoin is actually way worse for criminals than cash is, because cash can be truly anonymous, but there's always a trail when it comes to using something like Bitcoin. In that same way, there always being a trail if you track something or if you do something on a blockchain. This applies very well, and it's the same principle as what a lot of groups are doing on the supply chain side again. So what we're looking at here is essentially a coffee example where a number of brands, specifically European brands, wanted to trace their coffee that was moving out of Ethiopia, and they wanted to see, exactly how much their farmers were being paid. They wanted to see what plots of land and what regions this coffee was coming out of. And this is an example of a fungible asset. So we'll contrast this in a moment with an example of a non-fungible asset. But the reason that it's fungible is because coffee comes in big bags, and I can pour coffees together, I can swap them out, I can do all these things where, it's not unique, and it's not, one coffee bean is not unique. It is part of a very, very large batch of perfectly identical or, identical enough other coffee beans. So this is an example of, again, fungible assets being traced on the supply chain to track provenance, but then also to track labor practices and payments to farmers. And the way that this works is there is a link between every transaction. So this transaction was fairly large. It was about 20 tons or 20 metric tons of coffee, and that is actually linked to a unique transaction with a transaction hash and everyone's blockchain IDs. That's actually linked directly to, in this case, it was to our blockchain, but it can be done with lots of other blockchains as well. So again, this is an example of a fungible asset, i.e. coffee, being traced on a blockchain. And now switching over to a non-fungible asset or a non-fungible token, an NFT, that we keep hearing about. This would be diamonds, are NFTs. So this is a project, this is actually just kind of some example data, but there's a project happening right now that's looking to ensure that there are no conflict diamonds being mixed in with some of the diamonds that are coming out of South Africa and moving into a number of jewelers in the US. The key difference here, and again, going back to our token ontology questions, is how are we tracking the asset? Are we tracking each diamond individually, i.e. non-fungibly, or are we tracking them as an entire batch like we did with coffee? Diamonds, because they are so high value, because each record we want to kind of be uniquely defined, we want each record to be separate, we're tracking these as non-fungible tokens, again, contrasting that with coffee being fungible. Moving from typical supply chain examples, it does look like we have a few more questions.
Yeah, we have one from Rita. She's asking, can blockchain solve agricultural issues for food supply, or is the issue related to food waste?
So I'm not quite sure on the agricultural issues if you have something in mind in particular, but in terms of, we're seeing blockchain being used for certifications around land practices, especially around like some sustainable land management techniques. We're seeing certifications, blockchain-based certifications show up there. We are seeing labor practices being tracked and certified on the blockchain as well, in terms of like, is this source, is this origin actually like using fair labor practices? We're seeing things like that show up on the blockchain, as well as things related to to food waste or efficiency, or even recalls. One of the things that people are doing a lot of interest in on the blockchain side is saying, if I have an outbreak of some sort of contaminant, if I have more traceability in my supply chain, then I don't need to recall everything. I can trace back exactly to where that issue was, and I can do a more limited recall. So in addition to some food waste things, there's also a food safety interest that not only is in agriculture, but also actually applies to some pharmaceutical sectors as well. We're doing a project right now tracking COVID-19 test kits and ensuring that the cold chain is basically secure and unbroken, because tests for COVID-19, much like some of the vaccines for COVID-19, need to be kept within certain temperature parameters if they're going to remain effective. So if a batch is going to go bad, you want to make sure that you can trace that. But that's really no different than thinking of something quite similar to saying like, oh, is my poultry being kept at the right temperature? So a few different areas that that blockchains are being used in agricultural supply chains, from food safety to labor practices, all the way to things like food waste as well. But getting from maybe these simpler examples around supply chains, we can map a lot more complex things from the real world into the blockchain space as well, including land titling or streaming rights, or even kind of alternative investment classes. So, as I'm saying, beyond supply chains, certain types of, blockchain assets can be used to bring more surety to land titles, specifically in developing countries. Both Ghana and Georgia the country, not Georgia the state, are looking at overhauling some of their land titling systems using blockchain technology to really focus on being more inclusive to a lot of their kind of historical groups that were very focused on smallholder farming and things like that, but that maybe today can't actually get access to finance because they can't prove that they actually own or have rights to the land that they are actively farming, and in many cases have been farming for generations. So the idea of taking land titles, taking that as a token, taking that as an asset, mapping that onto the blockchain and saying, all right, now I can actually trace the ownership, and I can uniquely prove the ownership of a plot of land, and I can use a public blockchain so everyone can see that and everyone can understand that. That's on the land title side. On the alternative investment side, this is, I would say, the collision of two very commonly discussed trends right now in blockchains and NFTs, but then also in luxury goods investing. I think there was a report that came out a couple of years ago that ultra luxury goods, so high-end fashion, high-end jewelry, and art, was the best performing asset class of the last 50 years. But it might have been the best performing asset class, but it was also the most limited asset class in terms of who could participate. Because if I want to buy paintings and I want those paintings to be good and to be likely to appreciate in value, we're talking about them starting at hundreds of thousands, if not millions of dollars. What we can do with blockchain, though, and what we can do with tokenization using blockchain, is we can take something like a work of art, and this was actually done for one of the first times in 2018 with an Andy Warhol piece, where that piece of art was auctioned off bit by bit. So they took the piece of art, they mapped that onto the blockchain as a token, and then they allowed that token to be broken up into many different parts, so that I could own 1/1000th or 1/100th of this piece of art. I can make a more reasonable investment, but I can still basically participate in the value appreciation that I expect an Andy Warhol to actually go through. So probably a bit more of an exciting, a bit more interesting, but probably not as practical or likely to be as widely used example of tokenizations and blockchain. So we go all the way from supply chains to more interesting things like land titles and art, and actually even oddly enough, streaming rights for music or other forms of entertainment are being discussed about. Can these be put on the blockchain? I would actually very much expect Topl, the music streaming company recently purchased by Jack Dorsey, to be experimenting with these things in the relatively near future, as Jack Dorsey, founder of Square and Twitter, has been very pro Bitcoin and very pro blockchain over the last few years. Looks like we have a few more questions coming in.
When is the current legal and regulatory guidance on blockchain sufficient for most use cases? If not, what areas of federal policy are needed most? And is the lack of legal clarity deterring deployment of blockchain technology?
So there definitely is a bit of, I would say, a slowdown or a bit of a caution in terms of a lot of these projects, because yes, in certain areas there is a lack of certainty. I would say these lack of certainty is most acute with some of the financial applications, and really doesn't have any concern on the supply chain side. So if someone's interested in a supply chain project using blockchain, there's really no major regulatory considerations on that front. But if you're looking at launching bonds on a blockchain or alternative investments using blockchain, oftentimes that does introduce new regulatory or new legal considerations to think through. But interestingly enough, I consider those legal questions to be incidental, meaning that these legal questions actually relate more to the new model being introduced than the use of blockchain. So if we look at the artwork as an example, the regulatory question has nothing to do with blockchain. The regulatory question has to do with, okay, once I take a piece of art, break it up into 100 pieces, such that if someone buys that share of art, they're clearly not doing it to display it because they can't display it. They're only doing it for an investment. Okay, does that mean that art is a security and regulated by the SEC? So the questions are more brought up because blockchain allows a new model, but they aren't necessarily legal questions about blockchain. They're always legal questions about the underlying business model. Some people have criticized the US pretty heavily in this regard. I generally take a more charitable view that the approach has been sometimes slow, but always thoughtful and usually very consistent. And actually, even one of the SEC commissioners, the SEC being the group probably most involved in blockchain regulation, is actually affectionately referred to as Crypto Mom, because she has taken an incredible interest in blockchain technology and has really been very friendly and engaged in the space. And the US does actually have some pretty strong engagement from its regulators into the community. So again, it can be slow, but the dialogue is fairly robust and I think quite promising personally. Now, moving from, and we will obviously have time for some more questions at the end, because I am about to just look at the last section, and this is where I want to maybe speculatively a little bit talk about what we might see next with blockchain technology, essentially kind of calling our shot. So in order to call our shot, there's basically a principle that I want to introduce when it comes to blockchain trends. We seem to very much be in a space of what goes around comes around. So obviously right now we're going through NFTs. We hear about, the NBA doing things, the NFL doing things, huge companies doing things with blockchains and NFTs. Well, this actually isn't the first time this idea was introduced. Back in 2017, maybe some of you have even heard of these before, we had what were called CryptoKitties, which were essentially Beanie Babies or highly collectible, more digital Beanie Babies on the blockchain. And they became incredibly valuable, incredibly traded, and actually even briefly broke the Ethereum blockchain in the sense that there was so much traffic happening, people trading and trying to buy CryptoKitties, that you couldn't actually get a transaction through to do anything else. All the capacity in the network was being occupied with people trying to buy and trade these, again, basically digital Beanie Babies. So that's on the NFT side. And then before we had a lot of the current interest in DeFi and decentralized finance, we had a a collateralized debt obligation platform where I could literally create collateralized debt positions on the blockchain called MakerDAO. And this project actually goes back all the way to 2015, 2016. It was really popular at the time, faded into the background, and now everyone's talking about it again. So we have this principle of what goes around comes around. So if we have that principle of what goes around comes around, the question we should ask ourselves when we say, all right, what's next? We simply ask, well, what has gone around and hasn't come back around yet? And we find DAOs, or decentralized autonomous organizations, which again, as I said, is essentially the way that we can say, all right, let's take a fund, let's take a community, let's take an organization, and let's allow governance and voting for that organization to actually happen on the blockchain. So some uses of this might be LP-controlled investment funds. They could be donor-advised aid funds. They could be trade groups and industry associations, maybe standards bodies or certification bodies that the kind of industry participants want to have some role in guiding. And then finally, kind of open source technology projects, or again, digital bridges, digital highways. These are all potential DAO use cases and kind of the potential areas that we could see DAOs really start to emerge in. It's still a relatively small base or a small space with only about $1 billion currently managed by DAOs, comparing that to hundreds of billions of dollars that are now moving around in DeFi. There's obviously still a lot of room for this explosion in DAOs to basically happen. And maybe one of the early signs that we see of this coming is actually the state of Wyoming recently recognized, and I've got the bill over here on the right-hand side of the slide, recently recognized DAOs as a legal organization type. So, corporations, LLCs, sole proprietorships, and now DAOs in the state of Wyoming. So we're even starting to see some legal recognition for this new form of corporate or organizational governance. So these trends, in addition to some conversations that the space is having, makes me think that we might see DAOs as the next big thing in the blockchain space. So if anyone wants to hold me to that, you are more than welcome to. This is the end of the presentation. I want to thank you all again for participating, for your questions, and I do have some time to stick around now for further questions and further conversation. But thank you again, and thank you to our organizers for inviting me. It's been a pleasure.
Thank you, Chris. We have two questions for you, they're both from Greg. I'll read you the newest one first, and then the one that you mentioned getting back to.
Mm-hmm.
So he asked, are government success in using anon to retrieve / get back to cryptocurrency payments made to colonial pipelines has caused a 10%-ish drop in many cryptocurrencies? Do you have any thoughts on this?
I do have thoughts on this in the sense that one of the things that people have been trying to talk about with blockchains or Bitcoin for a long time is, how is Bitcoin correlated to other activities or other sides of the market? This has been an area hotly debated for years. There's been a strand of argument that says, oh, Bitcoin is, inversely correlated with the rest of the market, i.e. the market's doing well, I don't need a safe haven asset, I'm going to take money out of Bitcoin. People on the other side might say, oh, Bitcoin is incredibly speculative, so it's not a safe haven asset. It is it's a high growth, it's an optimistic asset. So there's always all sorts of different opinions as to what makes the price of Bitcoin go up or down. On this topic in particular, sometimes we'll see news about, oh, there's going to be a regulatory crackdown, or the DOJ is concerned about ransomware or about things like that, and then they might shut this down or try to go after it, and that might cause the price to go down. But sometimes that causes the price to go up because people are trying to get in before they think they won't be able to get into anymore. This most recent dip is, I think, interesting because it went against a lot of conventional wisdom that because the regulators were able to get around the issue, I think some people would have said, oh, that's a good thing, because now regulators won't be as concerned about it and there won't necessarily be a crackdown on it. But apparently the other sentiment won out that says, oh, this means that Bitcoin can't be used for the things we want to, or we think Bitcoin should be used for, i.e., doing things that are outside of central control. So in this case, that seems to be the narrative that won, but I would not be surprised if the next time we saw something like this, the price actually moved in the other way. Every time someone has a working theory for what's going to drive Bitcoin or cryptocurrencies, about a week later, there is a counterexample to that. So apologies for the non-answer, but it is definitely something that has been perplexing the entire space for pretty much the whole history.
Chris, we had that original question in the beginning of the presentation. How can we use blockchain technology to accelerate individual, multi-organizational, even jurisdictional collaboration to solve humanity's tough problems, such as decarbonization, climate change, pollution, poverty, and racism?
Yeah, absolutely. So I think there's two areas where we can think about this. Blockchains are very, very good, as I said, about being public infrastructure, but digital public infrastructure, in the sense that they give us a new model to create new pieces of the internet, new pieces of technology that really aren't owned or monetizable by any one party. So if I want to create a new data standard, but I don't want someone to own it, I might look to blockchain for that. So the idea of, again, digital commons being powered by blockchain is, I think, an important consideration for that. The second piece, though, is I take the view that blockchains and tokenization might be one of the missing pieces of how do we assign value to things that historically we haven't. So if we think about the idea of carbon credits, one of the biggest issues with carbon credits always has been this idea of, can I trust that an offset is happening? The two groups in the world that will actually talk about the double spending problem, i.e., I've got $20 in my account, I'm going to send you $20 and I'm going to send the same $20 to someone else. The only two industries that ever talk about that issue and are worried about that, it's the blockchain space and it's the carbon credit space. So the fact that blockchain can solve this double spending and this trust problem, I think will go a long way in just bringing more adoption to decarbonization and more adoption to carbon markets in general. By that same token, though, because blockchains are really good at creating these frameworks, we can start thinking about, okay, maybe I don't just have carbon credits anymore. Maybe I start having labor credits or water credits, and we can start bringing value through tokenizing some of these other public goods. But once something is tokenized, once something has a unit attached to it, once someone can see that thing, that's when we can start creating markets for things and kind of really driving some funding into these areas. So that's kind of my answer for that. But I think there's a few different areas on that front.
So Chris, we're already a couple minutes over, but I wanted to remind the attendees that you can see Chris's contact information. You can reach him at chris@topl.me, and I'm sure he will be happy to field your questions there. But Chris, thank you very much for sharing Blockchain Beyond the Hype. The recording of this session will be available next week on Improving's YouTube channel, along with our other virtual events. We are wrapping up day 3 of the Improving Edge conference. We have 6 more events coming your way. Be sure not to miss any of them. You can register for them at we can register for the Improving Edge events at theimprovingedge.com. Thank you all and have a great day.
Thank you.